or the integrated options portfolio. And our tagline is, it's not just what you own, it's how you own it. Now what that means is what we do is very different from any other money manager that I'm aware of, in that most all other money managers, they're focused on what stock they should own in a portfolio and when they should have it there, whether it's own it all the time or whether it's a tactical portfolio. Those decisions as far as what you're going to own and when you're going to own them don't change. They're modified very slightly from what you're already currently doing. What we do at Desert Rose is we take the option structure and we look at how that individual stock or fund could be owned and how it can be improved through the option structure. So let me show you what I mean by that. If we just look at a simplified version of what you might see out there, obviously this is dumbed down just for illustrations purposes. If we look at this and we say, okay, this is $1 million portfolio, this might be a 60% stock, 40% bond portfolio, something you might see out there. In this example, the advisor has decided with his client, hey, we want 22% or $220,000 in U.S. stocks, large U.S. stocks. And then typically what's going to happen in that situation is that advisor is going to look and pick out whatever individual stocks or funds that they like in that particular category. They're going to buy them and they're going to hope for the best. What we do takes it a step further. We say, okay, great, that's what you want to own. Now let's look at how we own it and see if there's an improvement there. So what we do is we say, okay, instead of taking $220,000 and buying the shares, let's buy options on those same shares, and we're only going to pay probably in this example about $20,000. Now we're going to be buying a call option that's going to be long term. It's usually typically good from 18 months to 3 years out. And that call option is going to lock in today's price on those same number of shares that we wanted. It's going to give us the full potential of the market in that particular, on those particular shares. So if they go to $1 billion a share, because we've locked in a set price, we're going to capture that through the options and what we make with the difference, which I'll get to here shortly. So the intent is that we will capture that full upside. And the other nice thing about owning a call option is, unlike futures, we have limited risk. We have only the amount that we've paid for the options. It's an option. It's not an obligation. And so we don't have to buy it at today's locked-in price. It's just an option if we want to at some point before that option expires. So because we haven't spent a full $220,000 on these options, we have in this example $200,000 that we can put into something more conservative. Now, right now this is all listed as additional fixed income. It doesn't necessarily have to be fixed income, and we'll get into that in a minute. But essentially, this piece is designed to be more conservative. It's designed to be more stable than those underlying shares. In this example, the S&P 500 or whatever fits that category that you like. And it's designed to produce income to help offset the cost of the options. When we buy call options, there are two things that are a cost or a drag on the performance relative to owning those same shares directly. One of them is we're not going to receive the dividend. If we had bought the shares directly, we will. Buying it through the call option, we won't. And then there's something called the time value cost, which is the extra time premium that we pay for owning those shares through the option. The longer the option's good for, the more we're going to pay for that. Those two combined costs, and this is very important to understand, those two combined costs are typically somewhere between 3 to 5% per year, which if that's all we were doing is just buying the options, that's a huge cost, and over a long term, we're not going to make near as much as if we bought the shares directly, except for years like 2008 and so on and so forth, and the argument could be said it's still worth it. But I would say if that's all we're doing, I don't want to do it. However, because we're able to put more money into this fixed piece or this conservative piece, If we can earn that 3 to 5% on that fixed piece, we're going to offset the cost of those options, and we're going to have the benefits of both the potential and the limited risk essentially without cost, depending on how much we can make with that fixed piece. So let's look at those two side by side. We call that a fully coordinated pair. So let's take a look. When you buy the shares of a stock directly, like the pie chart on the pie slice on the right side, you got an account value that's going to grow or shrink as the share price goes up or down in value. Okay? With the option structure, we purchase the options, we put the difference in this conservative piece. Again, doesn't have to be fixed income. And those two together, we believe, are going to outperform both as the market goes up. We feel like we should make just as much, and in the large majority of the time. And when the market goes down, there's a huge difference. So let's take a look. When the market goes up, we're going to see the majority of the growth in those call options themselves. And then we're going to continue to earn dividends and interest, typically on that conservative piece as well. So that between the two, our account value should grow just as much as if we bought the shares directly. But if and when that investment that was thought to be a good investment doesn't go up and goes down instead for whatever reason, it doesn't matter whether it's some headline risk or something going on in the world or that particular stock or fund. When the market goes down, like say in 08, when you own something directly, the entire account value is at risk all of the time for those particular shares. In this example with the IOP though, the only thing that we have at risk to that underlying U.S. stock fund in this example is what we paid for the option. And depending on where that conservative piece is, if it continues to grow and earn dividends over that 2 or 3 year time period, we may actually have a gain depending on how much we've earned in that fixed piece. Maybe we haven't earned enough to offset completely the cost of the options, but as long as that conservative piece is doing what it's designed to do, which is just chug along and earn some interest, then we're going to be far better off than owning those shares directly. The other really nice thing about this is the consumer, the end investor, isn't freaking out when the whole rest of the world is freaking out because their losses have been mitigated and isolated in those options. So they're not constantly thinking, man, what if it continues to drop, and wondering what they should do. We can then take a step back and say, look, do we still like this investment? Yes or no? It's beat up. It's down 50% in this example. Do we still like it? Is the world going to recover from whatever's happened? If the answer to that is no, we don't have to do anything. We don't have to buy the shares. We don't have to do anything. We can just continue with our conservative piece. But if the answer is yes, that we believe this is still going to be a good investment long term, we can take some of the dividends and interest that we've earned and purchase new options and lock in another 2 or 3 year time period. But what's interesting is we're not going to be locking it in at that original share price. We're going to be locking it in at the new price, the beat up price. And so if the shares continue to lose value and go down even further, again, our risk is isolated to those call options for those underlying shares. And that conservative piece, again, should continue to chug along, and we're going to be able to pick up even more options at an even lower share price if we want to down the road. That's our option, whether we want to or not an obligation again. But if, in this example, if the market continues to stabilize, let's say, and starts to go up and returns to where we originally started, the guy that bought the shares directly is just simply breathing a sigh of relief and is wondering, is it going to drop again? He's got all that anxiety still, whereas the option structure is now making pretty significant gains. And with the fixed income piece continuing to grow and earn dividends, we've got even more growth. And so now, even though the market just got back to where we started, we've got some nice gains on the IOP side of things. And as we adapt, this solves another problem or another issue that you have when you've got nice gains in an account. When you own the shares directly, Murphy's Law of Investing says that if you've got some good gains and you're wondering if there's going to be a pullback and whether you should take profits or not, Murphy's Law of Investing says that if you do sell the shares, there isn't going to be a pullback, and they're going to continue to go up, and you're going to be kicking yourself. Murphy's Law of Investing also says that if you do hold on to them and you don't sell, then there is going to be a pullback, and you're going to be kicking yourself because you're going to wish that you had done it. With the IOP structure, when we've got some nice gains in the account, what we can do is we simply sell the options that we've got the nice gains in, relock in at a new strike price, a new option price. We're able to take a lot of those gains in the call options off the table, not necessarily off the table, but shift it into something that's more conservative. And now we've got even more money earning dividends and interest to help offset the cost of the options. If the stock continues to go up, great. We've got options on them still. We'll continue to make money just as if we owned them directly or very similarly. And if it does go right back down to where it was previously, then again, now we've got even more dividends and interest earning money that we can use to buy even more options at that lower share price. So essentially, we expect to make just as much as owning those shares directly. We don't expect the call option costs to be a drag on the portfolio because they're offset by that conservative piece. And depending on where we put that piece, which I'll talk about in just a second, we may make more than what the options are costing us. We may make a little bit less, but ultimately it's the structure that allows us to own what we were going to own anyway, but through a structure that allows us to adapt to whatever the market then throws at us, whether it's up, down, or sideways. We don't care. We simply adjust the options accordingly. And that's really what we do at Desert Rose. Our job is to fine-tune what you're going to own anyway and adapt it so that it's structured for the best results for the risks and the rewards that you're concerned about and wanting to take advantage of. So from here, we do the same thing with everything else in the portfolio. And again, that's why we say it's not just what you own, it's how you own it. The decision to buy this particular asset is still there and is always going to be there. The difference is how we've decided to own it. So we go ahead and take this option structure, this IOP structure, and replace the direct ownership of that asset. And we do the same thing with all of the other pieces of the portfolio until we get a portfolio. In this example, it's a conservative portfolio. We've got 94% in something that's much more conservative than the market or than stocks in this example. And yet we have the potential, as if we had in this example, 60% in stocks. So it just has the, when times are bad, we actually own what's on the left. When times are good, we're going to have the potential of what you'd have if you'd held the stocks directly. And so let me just leave with this, that fixed piece, that's a whole nother conversation. But where we put that is obviously important, and it depends. The reason why we call it an integrated option portfolio is because we integrate what is appropriate for a particular client and what that advisor feels is appropriate for that client into that client's portfolio. And so if they need guarantees, I mean, we could go into CDs. We could go into short-term government securities if we wanted to. If they want to be more aggressive with the fixed income, we can get more aggressive. And our job is to help adapt the portfolio and adjust the portfolio so that it's integrated with what's most appropriate for that client. So what we end up having many times is shorter term, intermediate term bonds, munis, depending on if it's a taxable account or not. And in some cases, we have advisors that like to use insurance. And we can use cash value insurance as part of that fixed piece as well. And sometimes that's, what they've decided is most appropriate for the client. Some will even use annuities. Everything has its characteristics, and we help make sure that those characteristics work with the options, work with the strategy, and help improve the performance of your client's portfolio.